Hello everyone, welcome back to my YouTube channel. In the last class, we studied methods of calculating the depreciation amount. In that, first one is straight line method and second one is written down value method. So in today's class, we are going to learn methods of recording the depreciation. What are the methods of recording the depreciation? Before that, just we will recall what is depreciation. Depreciation, it means gradual decrease in the value of a fixed asset due to usage, passage of time or obsolescence. Right. Now, when we charge depreciation in accounts, there are two main methods to record it. So, let's understand them one by one. In that, see here in the books of account, there are two types of arrangements for recording depreciation on fixed asset. Their first one is direct method or asset account method, and second one is indirect method or provision for depreciation method or accumulated depreciation method. So in that first one is direct method or asset account method. See here, in direct method, depreciation is directly deducted from the asset account. In this method, depreciation that is directly deducted from the asset account. That's why we will call it as a direct method or asset account method. Right? And it means we reduce the value of the asset every year by charging the depreciation. In direct method, depreciation is directly deducted and we reduce the value of the asset every year by charging the depreciation. For that, the journal entry is depreciation account debtor to asset account. And what is the effect of balance sheet under direct method? Here, after posting this, the asset balance in the balance sheet, it will always show its reduced value. That is net book value, means cost minus depreciation, original cost of the asset minus depreciation, that is equals to net book value. So let's see the journal entries under this method. See, at the time of purchase of asset, we know, right, journal entry is asset account debtor to bank account. So this include cost of asset including installation, freight, etc. And second one, at the end of each year, two entries are passed. That is for deducting depreciation from the cost of the asset. That is depreciation account debtor to asset account. And second one, for transferring depreciation to profit and loss account. For that, entry is profit and loss account debtor to depreciation account. After calculating the depreciation, we need to transfer the depreciation to profit and loss account. So this records depreciation as an expense in profit and loss account. So let's see one example, then you will get a clear understanding of direct method. Clear? Suppose a company buys machinery worth rupees 1 lakh and charges 10% depreciation. First entry is at purchase, that is machinery account debtor to bank account. How much? That is rupees 1 lakh. And write down the narration, purchase of machinery for rupees 1 lakh. And at year end, so here year end, depreciation, two entries we will pass for depreciation and transfer depreciation to profit and loss account. So in that first one, for depreciation, we have to pass the journal entry. That is 10% depreciation, means 1 lakh into 10%, that is equals to rupees 10,000. So depreciation account debtor to machinery account, that is rupees 10,000. Now we need to transfer this depreciation to profit and loss account. So write down profit and loss account debtor to depreciation account. How much? That is rupees 10,000. Now what is the effect in the balance sheet? Here fixed asset appears as at its net book value. That is cost minus depreciation charge till date. That is 1 lakh minus 10,000 equals to rupees 90,000. So machinery will now appear in the balance sheet at rupees 90,000. So for next year, suppose the cost of the asset becomes rupees 90,000, and for that on 90,000 we have to calculate the depreciation. So 90,000 into 10%, 9,000. Now the effect in the balance sheet, 90,000 minus 9,000 becomes rupees 81,000. The value of fixed asset is 81,000 in the balance sheet. Clear? So this is the direct method. Here depreciation, that is charged directly or sorry, it is depreciation is directly deducted from the asset account. It is very simple, right? Just we have to calculate the depreciation on the original cost of the asset, and in the balance sheet we have to show the reduced value, that is original net book value, that is original cost minus depreciation charge. And in the second year we have to take into account the cost of machinery value rupees 90,000. On that again we need to charge a depreciation. Clear? In this way we need to calculate the depreciation under direct method. And so next we will discuss about indirect method or provision for depreciation method. Clear? So first let's see what is provision for depreciation. Provision for depreciation, it means it is an account created to collect all depreciation amounts year after year instead of reducing the asset account directly. Depreciation means it is an account created to collect all depreciation amounts. So in this method we do not reduce the asset account directly. Here what we will do, instead we create a separate account called provision for depreciation or accumulated depreciation. And in this method the asset is always shown at its original cost in the balance sheet. In this method the asset is always shown at its original cost. Clear? So the total depreciation till date is shown separately in the provision for depreciation account. So finally in the balance sheet the original cost of the asset minus provision for depreciation equals to net book value. Okay, so in the balance sheet we have to write down the net book value, that is cost of the asset minus provision for depreciation. So let's understand through one example. See, here also the same journal entries we need to pass. Asset purchase, asset account data to bank account, right? And at the end of each year 2 entries for charging depreciation, but here depreciation account data to provision for depreciation account. Clear? Provision for depreciation account, and for transferring the depreciation to profit and loss account, that is also same, provision profit and loss account data to depreciation account. So let's see one example. Suppose a machinery is purchased for rupees 1 lakh with a depreciation at 10% per annum. First, for purchase, the journal entry is machinery account data to bank account, that is rupees 1 lakh. And depreciation for the year, depreciation account data to provision for depreciation, that is 1 lakh into 10%, 10,000. And after that we need to transfer depreciation to profit and loss account, that is profit and loss account data to depreciation account, that is rupees 10,000. Now in the balance sheet 1 lakh minus 10,000, that is equals to rupees 90,000 net book value. Clear? Now in the year second, depreciation again rupees 10,000, that is added to provision. So now provision balance that becomes rupees 20,000. Rupees provision of balance that becomes rupees 20,000. Right? For that I said we create a separate account called provision for depreciation or accumulated depreciation. And in this method we do not reduce the asset account directly. Here then our provision it becomes rupees 20,000. Now balance sheet, this depreciation again rupees 10,000, that is for year 2. Clear? Now balance sheet that will show machinery rupees 1 lakh. Machinery rupees 1 lakh means original cost of asset. But in direct method what we will do, for year second we will use this reduced value, that is rupees 90,000. On this again we will calculate the depreciation, that is 9,000, and it becomes rupees 81,000 in the balance sheet. But here for the second year in provision for depreciation account we will take machinery's value original. We will take original cost of the machinery, that is rupees 1 lakh. And we will deduct provision for depreciation, that is rupees 20,000. That is rupees 20,000. So our net value that is rupees 80,000. Suppose if there is year 3 again we need to add rupees 10,000 added to the provision, then it becomes rupees 30,000. And again the balance sheet will show machinery rupees 1 lakh and provision for depreciation 30,000. Net value becomes rupees 70,000. Clear? So this is what direct method and indirect method or provision for depreciation method. Clear? So direct method, asset balance reduced every year. Asset balance reduced every year. See the example here. Here at the year end, this is suppose year 1, right? So it becomes rupees 90,000. In the year 2, year this is for year 1 and year 2, 90,000 minus 9,000 becomes rupees 81,000. See, that is what asset balance reduced every year. But in provision for depreciation method or indirect method, what happens? The asset remains at original cost. Asset remains at original cost, that is rupees 1 lakh only. See, in the year second also machinery value it remains same, that is rupees 1 lakh, right? But the depreciation that is collected in a separate provision account, that's it. That is only the difference. We need to create a separate provision account for depreciation. So this is about methods of recording depreciation, that is direct method and indirect method. Clear? So I hope this concept is clear to you all. If not, please leave a comment. Thank you.